Hello dear student, in this particular video I am going to give you a brief demo of topic financial management. That chapter is relevant for all BBA and BCom examination. I am going to give you a brief description for all the chapter that we have in CA interlevel and BCom BBA exam. Let's show and let's discuss with the session. Now continue with the classes. See, in financial management, what we have the chapter that we basically all universities cover, whether it's Indian university or foreign university, because financial management is an international subject, right? It doesn't matter it's Indian university or foreign university, all university have a common topics. The point is only that few topics are added or deleted in university level. So what is the topic that we will continue in our class? That is first EBIT EPS analysis. First, that we have leverages analysis, then we have cost of capital, then we'll find the value of the firm, then we have capital budgeting, then we have working capital management, receivable management, cash management, inventory management, and the theory parts. Right, one topic is missing in this unit, and that is time value of money. Right, actually time value of money is nothing, not a separate topic, but in some of the books it is given the separate topic. Time value of money is all about a financial fundamental topic, because financial management it's itself concerned with the time value, because in accounting we always calculate the present value. We always talk about the present values, which financial management always discuss on the present data and will always calculate the future values. Right, what will be the impact, what will be the impact on profitability, what will be the impact of sales. Right, so we can say that financial management is concerned with the calculating future values based on the present or past data. Right, that we have the subject. Time value of money is what I have told you. Time value of money basically calculate the difference between present value and future value. Present value that as on today, and future value that we have to pay or we have to receive in some future time. Right, let's discuss how we calculate and what is the format of EBIT EPS analysis. What is actually, so this is the format of calculating EPS. What is the EPS? EPS is simply what? Earning per share, right? EPS is what? Earning per share, means what is the earning per share. Suppose I have invested my 1 lakhs rupee and I purchase a company's particular shares, and that I have invested. If I want to check my earning per share, then how will I calculate the earning per share? Formula is what? Earning per share formula is your earning available after paying all interest, dividend and taxes, and that is divided by your number of shares. Number of share means the number of held by you. But this is the EBIT EPS analysis company as a whole, not as a particular investor point of view. So we will calculate EPS as a company as a whole. So how we will calculate? Let's check. First we have the EBIT, right? First we have EBIT, then we'll deduct the interest payment. EBIT is what? Earning before interest and tax, and sometimes it is also called profit before interest and taxes. Then we'll deduct what? Interest, and after deducting interest, what we will come? EBT. This is not EBIT, this is EBT, earning before tax. Then we will deduct what? Taxes. Then we'll get what? Earning after taxes. And after paying preference dividend, this is not equity dividend, because equity's point of view we are calculating EPS, and preference dividend is what? Like company's liability. So we will pay dividend first to them. First company declare dividend to preference shareholder, and after paying preference dividend, whatever amount that we have left is earning available to equity shareholder, and then we'll divide this value from total number of equity shares and we'll get what? EPS. Clear? Clear? Suppose EBIT that is given to you is EBIT of a company, particular company, suppose 2,50,000. Right, company is having 10% loan. Company has taken what? 10% loan from the financial institutions, and that value is rupees 5 lakhs. Is it clear? Right, data is given to us and we will calculate what? EPS. Now suppose company is having 10%, suppose company is having 10% preference share capital, and that is amounting 3 lakhs. Okay, Now suppose company is having tax rate that is given to us is 50%. Company is having tax rate that is how much? 50%. Clear? Okay. Clear? Okay. So question is asking what is the EPS? Question is asking what is the EPS? So how we will calculate? We simply put the statement wise formats. First we will put the values of EBIT that is given to us, that is how much? 250. Right. Then we will deduct what? Tell me. If you remember the chart, interest will be calculated on this value 50 on 5 lakhs. So that is 5 lakhs multiplied by how much? 0.10, that is 10%. Clear? That is 50,000, and we will deduct 250 minus 50, and this value is called, tell me, this value is what? EBT, earning before taxes, right? Then we will deduct what? Tell me. Taxes, and tax is paid on the EBIT. Always remember, tax is paid on the EBIT, right? As interest is paid on its value, face value, and tax is paid on the EBT. If we have positive EBT, then we will pay tax. If we have zero EBIT or negative EBT, then we will not pay any taxes. Clear? Okay. So on 2 lakhs, we will pay how much? 0.50. This is 50%. Clear? 1 lakh will be our taxes. Clear? And after taxes, this value will called EAT, earning after taxes. How much? This is 1 lakhs. Clear? Let me put the formula here. 2 lakhs minus what? Taxes. This is 1 lakhs. Now we will deduct what? If you remember the format, well, we'll pay the preference shareholder first. That is called preference dividend. That is called preference dividend. And their value is how much? Their value is 3 lakhs. So we will pay to them 10%. 10% will be 3 lakhs multiplied by 0.10, 30,000. That's come to 30,000. Right. So this is amount that is we call earning available to equity shareholder. Right. That ultimately shareholder will enjoy this amount, that is equity shareholder. And how much it is? It is 1 lakh minus 30,000. This is 70,000. Clear? Now this is earning available to equity shareholder. Now one data I have forgot to give you. Suppose companies already have a equity share capital, and its face value is 10. Face value is 10, and it is amounting how much? It's amounting 6,50,000. Right? Company already having equity share capital fund 6,50,000. Its face value is 10. So can you tell me the number of shares? Number of shares 65,000, right? Because it is 6,50,000. 650 divided by 10, that will become number of shares, right? So can we put here the formula 650 divided by 10, so that will be number of share how much? 65,000, and we'll get the value of EPS. EPS is what? Earning available to equity shareholder, that is this one, and divided by what? Number of shares, 65,000. This is, and 1.076 something is what our EPS. This is how we can calculate the EPS of any company. This is the simple example that we have discussed. And what will happen in the question? Question will be given the case study form, or in case of a long form, we just find out these values. Before putting the values in the statement, we just write down the values from the questions, and simply we solve the question like this. Right? Question will be the same, format will be, everything will be same. Just only simplicity is I have put the values here, and when we will solve your question, we will put the values one by one and then solve in the same way. Right? This is what EBIT EPS analysis, a simple this one. For the simplicity, we can say that EPS is what? Instead of putting all the values in this statement, we can simply make a formula of EPS, that EBIT minus interest multiply 1 minus tax and minus preference dividend whole divided by number of shares. This is what we can directly calculate the value of EPS. So you have the choice whether you can put the statements form or whether you can apply the formula. Both in both answer will be same. Clear? Is it? This is the equation format formula and this is the format. Whatever question will ask, we will put the values in the same and we'll just find the answer. Okay, next we are just simply discussing the overall chapters of financial management. We are not going into depth of any particular chapter. Second, we have suppose chapter is leverages. Leverage is something what? Leverages is something a relationship. It is particularly a relationship between two interrelated variables. What is interrelated variables? We apply the same this concept. Suppose this statement we can if we correlate what is the EBIT in terms of EBT, what is the EAT in terms of EBIT. If we simplify the relationship between two variables, that chapter will told us that this the discussion in that chapter is called leverages. Leverages. Some we have to calculate three leverages in this chapter. What are the three leverage that we have to calculate? First is operating leverage, second is financial leverage, and third one is combined leverage. This chapter is totally formula based chapter and this chapter is also related to EBIT EPS analysis chapter. It means if we are comfortable with the EBIT statement chapter, we can easily solve this all these leverages, right? On the chapters, when we do the chapter in detail, we'll discuss the formulas of all these leverages. Clear? Okay. Next chapter that we have is valuation of firm. Valuation of firm. Like we have calculated EPS, like we have calculated EAT. So one chapter we will be having, that is valuation of shares. In this chapter, we will calculate the value of any particular company. So in this chapter, we will calculate the value of equity, value of debenture, value of firm, right? Whether it is more or less, what should be the value of firm. And when this chapter is relevant, the practical scenario, whenever two companies are going to merge, right? Are you getting? When two companies are going to merge and when one company is going to buy another company, then its financial manager has to do what? Has to calculate a estimated value that we need to pay to another company. That is the relevance of this chapter. So how the formula has been calculated, what is the basic content of this chapter, that we will discuss in the valuation of chapter. And this basically the formula of value of firm is the formula value of firm is equals to value of equity and value of debt, right? Value of equity we will calculate by different formulas, and same way we will calculate value of debt, and value of both combinedly called what? Value of firm. Clear? Okay. Next we have cost of capital chapter. This is a very beautiful chapter. Cost of capital is simply means whatever capital that you have. A company's cost of capital consists of what? Let's again come to the Excel. A company got fund from various sources. Suppose companies got fund from the equity shareholders. Company get funds from the preference shareholders. Right? Company get from the debentures. Company get loans from the markets. Right? Company get public deposits, right? These are what? Source of funds. Are you getting the chapter? Public deposits. So all these are our sources of fund, but each and every have a, sorry, one of its content is very important, that company maintain, that is retained earning, that is called reserve. So each and every fund have its own cost. Suppose equity shareholder cost is called KE, that is cost of equity, right? Cost of preference share is called KP, cost of preference share. Cost of debenture is called what? KD, cost of debenture is KD. Loan is also called KD. Public deposit KE, and this is public KR. All these are denomination of what? Cost of capital. What is the cost of capital? Equity shareholder we have to pay dividend, so dividend is the cost of capital. Preference shareholder, to them we have to pay preference dividend. Debenture and loan, we have to pay what? Interest. So interest is the cost. Public deposit, we have to pay the interest. So it's a cost of capital. And retained earning, ultimately it's a KR, and we can say that there is nothing cost in cost of retained earning because it is our own fund, it is our own saving from the past earning, right? So we will discuss all these things in this particular chapter, that is cost of capital. We will apply so many formulas. What is the cost of debenture, redeemable debenture, irredeemable debentures? Then we will come to the another scenario. What is the cost of equity shares? What is the formula of different equity shares calculation? Then we will understand the weighted average cost of capital, how it is being calculated. Then we'll come to the cost of preference share. Cost of preference share, again it can be redeemable, it can be irredeemable, right? So these are the chapters that will discuss the what is the cost of capital of the firm individually and in aggregate. Individually it is what? KE, KR, KD, and aggregate it is called what? WACC, weighted average cost of capital. Clear? Dividend decision, we will discuss the Gordon model method, Walter model method, and approach. Means Modigliani Miller approach. Some of the theory says, try to understand. Some of the theory says if you declare the dividend, your share value will increase. Some of the theory says that there will be no impact of your company share if you whether you declare the dividend or not. So we will discuss the impact of dividend by different philosophies, and we'll try to find out the rational answers. So this is the chapter. They will discuss three approaches. I already told you: Walter model, Gordon model, and approach. And we'll again apply the formula in this particular chapter. Gordon model specify some formula, Walter model apply some formula, and approach simply says, approach is a very different approach. Approach says that there is no impact of dividend of the value of the firm. Clear? This is all about dividend decision. Next, in theory, this question is being asked very repeatedly in all the exams. This theory says that question asked in non exam, what are the three critical decisions that a financial manager has to take? Broadly, financial manager has to take three decisions: finance decision, investment decision, and what? Dividend decision, right? And all these decisions are related to funds of the company. How the fund related to this? Finance decision is basically termed with the how and how much funds should be raised from the market, right? This is what? Finance decision. Investment decision is what? If you have the fund, then where you will invest the company's fund so that get higher or maximum return. Clear? Third one is dividend decision. If you have a profit, whether you will declare it or whether you will retain it to use for the future expansion. These are the three decisions that we have to take. Clear? Very clear? Right. So these are the three approaches, and then we'll come up with the operating cycle. Operating cycle simply means operating cycle is a cycle that time that you take to conversion of your finished goods, conversion of your raw material into finished goods. Sometimes there are very large amount involved in the operating cycle. Sometimes we have to take decision that how much amount should be in our operating cycles. The operating cycle simply I have told you what it is: a cycle of converting your raw material into finished goods. In this chapter, we will study working capital management, receivable management, and cash management. Right? Working capital management is simply was what should be the amount of capital that you have to keep to meet your daily requirement, and that simply is what? Current assets minus current liability. This is your current assets, and then your current liability. Whatever your current assets are in the form, you will deduct from the current liability. That we will get the working capital requirement of a business. Clear? Yes. Basically this is your operating cycle. This diagram, you can see that from the market we purchase our raw material, then we put that raw material into factory factory make it product at a finished goods, then it come to the warehouse, from warehouse we sold to the customer, then customer we realize the amount, then will again our cycle repeated. This is what operating cycle. The longer cycle period, the longer amount is required because we have to meet the expenses. Shorter will be the operating cycle, lesser amount we will require. Clear? Clear. And next we have inventory management. Inventory management means what is the level of inventory that we have to maintain in our warehouse, because inventory itself has a cost. What is the inventory cost? We have cost of order, we have a storage cost. To minimize these costs, we have to calculate a very beautiful formula, that is EOQ, economic order quantity. Right? When we'll study this chapter, we will solve many questions of related to EOQ. So we will calculate EOQ, we will calculate number of order that we have to make, and we have also calculate time gap between two orders. So this is all about inventory management, right? Then we will study the receivable management chapter. Receivable management is basically what concerned with your debtors, because debtors, these are the person that you give them credit to get your payment of your goods and services. So we have to maintain our debtors, because longer will be the credit period, there will be a time lag between receipt of payment, so you have to maintain your own funds. So we will calculate what is our debt, what is our debtor as on today, whether this is, whether it's good, whether it's bad, whether they are paying regularly, whether they are not making payment. So in the practical scenario, there are separate department who manage our debtors. There are so many jobs in MNCs that they provide. If you have already, if your colleague working in that, suppose Genpact, Wipro, all these company make the profiles of account receivable, account payable. All these job are related to basically debtor management, right?